Hey guys, it's Imran Larka from Options Insight again. It's been a little while, so thought I'd do an update on markets and where we are and how I'm looking at it, what I'm thinking, how my views may have changed, that sort of thing. So let's kick it off with stocks. So we've got the S&P. Obviously, since the sell-off in March and the recovery, it's just pretty much been one-way traffic. S&P has smashed through all the retracement levels, and it just keeps marching on. Kind of got up to about 32.30 at the highs, I think it was, before having a little pullback the last couple of days. Nasdaq actually took out all-time highs, went through 10,000. Again, that's having a small pullback. But that the US equity market has just been absolutely bulletproof in the face of what we've experienced in the real economy. And the whole thesis of selling rallies because we are in a bear market and this is a bear market rally, a lot of people have been carried out with that view. How have I managed it? I pretty much gave up selling the squeezes once we sort of got through 2800, 2850, and I just kind of went a bit into wait and see mode, because it just seemed that the dominant narrative of, we're going to get a recovery, the worst is behind us, the curve is flattening, all those things were driving the optimism. And despite, most macro players and experienced veteran money managers kind of looking at valuations and seeing this equity market as very, very expensive and not wanting to touch it, the truth is the retail crowd, the Robin Hooders, as they're called these days, have piled into the market, and they've basically been buying everything from oil stocks to FANG stocks to even airlines, and that has driven these markets to amazing levels. Now the airlines, I have to say, is a head scratcher for me. I think airline businesses are in serious trouble, even in a post-virus world. I think it's going to take a long time for people to feel comfortable traveling to all these various destinations, and I think airlines' revenues are going to struggle for a long time, and people like American Airlines, arguably, I don't know if they're going to survive this, right? So keep an eye on the airlines, I would say. But that's basically kind of stocks. I mean, I think probably an interesting stock move recently has been the Russell. I may have mentioned before, the Russell 2000, which is the small and mid cap index in the US, is going to be more, in theory, is going to be more anchored to reality than, say, the S&P and the Nasdaq, which are getting driven up by these big tech names. Having said that, the Russell had a very, very strong catch-up rally recently, but the valuations in the Russell and the fact that a lot of these companies are going to go bust in this environment, and it's just a matter of time and for waiting for those bankruptcies to come through and stuff. It's a much easier short to justify in my mind, right? I could be short the S&P or the Nasdaq and just watch these FANG stocks go up and up and up. And the truth is, Amazon is smashing it in terms of earnings, revenue, stuff like that. Arguably, I think Facebook and Google are going to struggle because a lot of their revenues are from advertising, but for now they're still getting bought. But there are a lot of tech companies that are benefiting from the kind of acceleration in move to online and digital type platforms and ways of working and stuff like that. So there's clearly it's two separate economies, right? There's the economy of things. There was a good podcast that I heard talking about the economy of things and the economy of bits being computer bits. So you've got the economy of bits, which is absolutely booming because all business is now being transacted and done electronically. All meetings are done electronically via video and stuff like that. So the economy of bits is absolutely smashing it. And so it makes sense that the tech space is leading. And then the economy of things that are manufactured and consumed physically in that way, that is doing pretty badly, right? So like the cars, the airlines, you know, travel, leisure, hotels, all those things are struggling and probably will continue to struggle. So, you know, you can understand why the tech stocks are flying, but if you believe that this economy is potentially going into certainly in a recession, but it's going to be in a depression and it's going to take longer to get out of than is being priced in, then a safer way to play that short side of equities is probably the Russell, and that's kind of how probably the thing I'm most convicted about in terms of being short right now. I had previously said I thought that Europe would also be more anchored to reality, but that kind of changed. I mean, the DAX, I don't know if you've been watching the DAX, it had a spectacular 20% rally from sort of middle of May. And there was a big catch-up move in Europe where you had the whole sort of EU recovery fund and the agreement about them, you know, pretty much coordinated policy across the region. Pretty much Germany saying, yeah, we'll buy Italian debt and, you know, we'll help out the Italians and the other countries, right? So, you know, some kind of agreement and some kind of collective resolution in Europe that seems to be going through. That I think they announced about 1.5 trillion, I believe, is the kind of numbers they're throwing around in terms of support packages for the pandemic relief. And yeah, those sort of numbers are only likely to go up, I would say. So, you know, that led to a bit of a catch up in Europe, where Europe markets were lagging the US. And we had this sort of big 20% rally in the DAX, Euro stocks, all those other things, kind of similar sort of story. Is that done? The way I kind of think it probably is done for now. I don't think the outperformance of Europe continues. So yes, Europe could get dragged up if the US carries on rallying. But that kind of catch-up trade, I think, is probably towards the end, if not already finished. And certainly in the latest downtick over the last few days, Europe's been pretty heavily hit versus the US. So yeah, back to that sort of level. So that's kind of where we are in stocks. So since we've had this sort of recovery and this massive rally in stocks, this optimism, kind of normalization and hope for the market going back to normal, an interesting thing is what's happened to the dollar. So the DXY is probably the easiest way to see it. You can see here, dollar had been pretty range bound from sort of April, May, and then from the end of May, it started to crack to the downside. It broke this key level of 98.5 and has slid all the way to 96. And you know, the dollar had been a safe haven, let's say, in that March period. So, you know, people maybe were a bit sort of camping out in dollar cash as a bit of a safety trade. And as optimism has returned and you're seeing, you know, things like Europe and the Russell rallying, people getting more optimistic, then it kind of makes sense that dollar safety bid should go away. And we've had a bit of a weakening of the dollar. Now, if you look sort of at the bigger picture in the dollar, you got a massive level down here in the kind of 94.5 sort of area. We haven't broken that yet. You know, longer term, that would be an important level to break. If you see, yeah, if that gets taken out, then the whole sort of dollar bearish story takes hold, and who knows. But I don't really think that can happen unless equities just keep flying, right? So all these trades, all these macro trades are kind of correlated at the moment, right? So you've got certainly the dollar and equities trading together, right? So as equities rally, as risk assets rally, so oil, commodities in general, like industrial commodities like copper, aluminium, nickel, as they rally, as oil rallies, as equities rally, the dollar weakens, right? So that, for me, that correlation is likely to remain. So just kind of watch that space, really. The emerging market currencies, I mean, you can see this is just the broad dollar index, but you know, the move has been even more pronounced in emerging markets. So probably the highest octane one is this one, Brazilian Lira. And you've had massive move in Lira from sort of 420 up to 6-ish, and it's retraced all the way back to 490. So that's a big retracement for that currency. I mean, to be fair, if you look at Brazil and what's going on with the virus cases in Brazil, arguably that's done too much, right? So I wouldn't be surprised to see further weakness in the Brazilian lira, just because that economy is going to struggle, um, and that dollar might recover a bit against that, along with and other emerging markets like, for example, South Africa. Same kind of story. It's had a decent pullback to quite big retracement levels, and dollar mex as well was another one. Dollar mex kind of pulled back to quite key levels here. So those are the emerging market currencies to keep an eye on. Dollar mex, dollar Brazil, dollar South African rand. All those things have had some pretty decent pullbacks. So if the dollar is gonna have a bounce, then I think against those emerging market currencies is probably where the higher beta opportunity lies. So that might be worth an opportunistic trade to try and sell those currencies against the dollar. What else? Gold. Obviously my favorite commodity, gold. How's that been doing? It's been doing pretty well in the face of a risk asset rally where you would have expected safe havens, like we've seen the dollar weakness, right? You'd expect gold to experience quite a bit of weakness as well. Not really happened. Let me bring up this chart. So you see, this trend since last summer, this uptrend. You had this major breakout from multi-year resistance around summer last year that went through 1350, took gold onto this uptrend, and it's been holding this kind of uptrend for the last year, let's say. You had the sell-off in March. Obviously, every asset got smoked, massive liquidation that took gold to like 1450 area. But as it got back above this uptrend line, it's been holding really well. I mean, it tried to push through the highs briefly in May, failed there because I just think every man and his dog was long gold, and if you look at some sentiment indicators, just everyone was bullish. So it had to have a consolidation, but it's doing pretty well consolidating. I mean, I think if it can hold above the 1650 level, it's onwards and upwards for gold, right? I mean, like I say, ultimate targets for gold need to be, and when I say ultimate targets, I mean by the end of this year. Is 2000 realistic? I don't see why not, right? So provided it can hold on to these levels at 60, I think 1650 is a big level. I think 1600 probably offers some support as well. If it can hang on to those sort of levels in the face of a rallying equity market and general risk asset bid, if it can manage to not go below those levels, then you would have thought if weakness comes back, then this thing should do okay, right? So worth keeping an eye on gold. And then finally, I wrote an article recently talking about my views, and I basically put my hands up and accepted Bitcoin as a legitimate asset class. And I'm not just saying that because Paul Tudor Jones said it, and I want to follow what he's saying. But I was starting to think. I mean, there's a few market commentators who have basically been talking about Bitcoin. I know how it it does deserve a place in a portfolio, and I've kind of come on to that side of the fence as well.